Cost Accounting Mastery Techniques for Strategic Cost Management. Introduction to Cost Accounting. Cost accounting definition: a system of recording, analyzing, and reporting costs to help in financial decision-making. Focuses on internal cost information for management use. Purpose of cost accounting techniques: control and reduce costs throughout the organization. Assist in budgeting and strategic planning. Improve pricing strategies and enhance profitability. Support performance evaluation and decision-making. Cost accounting provides the foundation for effective cost management. Fundamental cost classifications. Fixed costs remain constant regardless of production levels. Examples: factory rent, management salaries, insurance premiums. Variable costs change directly with production volume. Examples: raw materials, direct labor, commission payments. Semi-variable costs contain both fixed and variable components. Examples: electricity bills with base charges plus usage costs. Direct versus indirect costs. Direct costs, directly traceable to specific products. Indirect costs, overheads cannot be directly traced to products. Cost classification examples. Practical cost examples. Fixed cost, factory rent of $10,000 per month. Variable cost, raw materials at $5 per unit produced. Semi-variable cost, telephone bills with $100 base charge plus usage fees. Direct cost, wages paid to production line workers. Indirect cost, office supplies and administrative expenses. Understanding these classifications helps in accurate cost allocation and control. Absorption versus marginal costing. Absorption costing includes all production costs, both fixed and variable, in product cost. Assigns fixed overhead costs to individual products. Required for external financial reporting. Marginal costing includes only variable costs in product cost. Treats fixed costs as period expenses. Better for internal decision-making. Key difference: absorption costing spreads fixed costs across products. Marginal costing keeps fixed costs separate for clearer decision-making. Absorption costing calculation: total product cost equals direct costs plus allocated overhead costs. Step-by-step example. Direct material cost equals $500. Direct labor cost equals $300. Allocated overheads equals $200. Total cost per unit equals 500 plus 300 plus 200 divided by total units produced. Benefits: provides full cost information. Required for inventory valuation. Helps in long-term pricing decisions. Marginal costing calculation. Total variable cost equals direct materials plus direct labor plus variable overheads. Step-by-step example. Direct material cost equals $500. Direct labor cost equals $300. Variable overheads equals $100. Total variable cost per unit equals 500 plus 300 plus 100 divided by total units. Benefits: simpler cost calculation. Better for short-term decision-making. Clearer contribution analysis. Contribution and break-even analysis. Contribution per unit. Contribution equals selling price variable cost per unit. Represents the amount each unit contributes to covering fixed costs. Break-even point. The sales level where total revenue equals total costs. BP units equals fixed costs divided by contribution per unit. Strategic importance. Shows minimum sales required to avoid losses. Helps in pricing and volume decisions. Break-even analysis example. Given information. Selling price per unit equals $20. Variable cost per unit equals $10. Fixed costs equals $5,000. Calculations. Contribution per unit equals $20 to $10 equals $10. Break-even point equals $5,000 divided by $10 equals 500 units. Interpretation. Company must sell 500 units to break even. Each additional unit sold contributes $10 to profit. Cost volume profit analysis. CVP analysis purpose. Examines how changes in costs and volume affect company profits. Helps in strategic planning and decision-making. Target profit formula. Target sales volume equals fixed costs plus target profit divided by contribution per unit. Applications. Pricing decisions. Product mix optimization. Capacity planning. CVP analysis example. Scenario. Fixed costs equals $5,000. Contribution per unit equals $10. Target profit equals $2,000. Calculation. Target sales volume equals $5,000 plus $2,000 divided by $10 equals 700 units. Business insight. Company needs to sell 700 units to achieve $2,000 profit. This is 200 units above the break-even point. Standard costing introduction. Standard costing definition. Predetermined costs based on estimates for materials, labor, and overheads. Serves as a benchmark for performance measurement. Uses of standard costing. Cost control and monitoring. Performance measurement and evaluation. Budgeting and planning support. Pricing decision assistance. Standard costs provide targets for efficient operations. Variance analysis basics. Variance types. Material variance, differences in material costs from standard. Labor variance, differences in labor costs from standard. Overhead variance, differences in overhead costs from standard. Variance classification. Favorable variance, actual costs less than standard costs. Adverse variance, actual costs exceed standard costs. Variance analysis identifies areas needing management attention. Activity-based costing, ABC. ABC concept. Assigns overhead costs based on activities rather than simple volume measures. Provides more accurate product costing. ABC implementation steps. Identify key activities in the organization. Assign costs to these activities. Allocate activity costs to products based on usage. Benefits. More accurate overhead allocation. Better understanding of cost drivers. Improved pricing decisions. ABC calculation example. Example setup. Total overheads equals $10,000. Cost driver, machine hours. Total machine hours equals 500. Calculation. Overhead rate per machine hour equals $10,000 divided by 500 equals $20 per hour. Application. Product A uses 10 machine hours. Overhead allocated to product A equals 10 times $20 equals $200. Just in time, JIT, costing. JIT philosophy. Produce goods only when needed to minimize inventory costs. Focuses on eliminating waste and improving efficiency. Cost benefits. Reduces storage and holding costs. Minimizes obsolescence and waste. Improves cash flow management. Enhances quality control. Implementation impact. Lower inventory carrying costs. Reduced space requirements. Faster response to market changes. Thank you for watching. You now understand fundamental costing methods, break-even analysis, and advanced techniques like ABC and JIT. These tools will help you make informed cost management decisions. Next, We'll explore how these costing concepts apply to budgeting processes.